Folks, with real estate investing, we talk a lot about price. We talk a little bit about inventory or supply, but I think the missing element is the other side of the supply demand equation, and that is demand. So we have the one and only Lance Lambert from Fortune, who does everything housing, housing, housing. We got to talk about the demand side. How you doing, Lance?
Yeah, two sides to every market, supply and demand. So let's talk about demand this week.
Yep. So I see you sent out again. You have a great Twitter page. Please tell people what that is. But you basically asked a question that I asked my audience on Monday about what are you guys seeing with demand? Are open houses going? Are mortgage apps ups? What is going on? Because me in my little world, I saw a noticeable change. But you have your fingerprints on a lot of the country and great relationships. So what the heck's going on with demand?
Yeah, so I think there's two things with demand. The first being that we have moved in a little closer to the spring season. And so there's
Sure.
that seasonality effect. The market's starting to come alive a little more. People are starting to list their homes or not list them. And then also some buyers are starting to kind of dabble in and see what's available as we kind of move into those bigger months of April, May, June. That's one side. Then there's the other side, which is the fact that the way up, as mortgage rates move up, there's a mortgage rate shock, right? Not only is it making those monthly payments higher and the down payments higher, it's also well, not the down payments, but the monthly payments higher. It's also getting a lot of people to where they don't have eligibility anymore, right?
Yeah,
So the number
exactly.
of people who could no longer afford a $400,000 mortgage fell by not a number in the millions, in the tens of millions, as
Right.
mortgage rates got up to 7%. But that's the way up. On the way down, it's actually depressurizing affordability and making affordability much more affordable and unlocking those people to have eligibility again. So there were some people in the latter half of last year who were planning to buy a home or even had one going under contract with a builder, and they couldn't go through with it because they lost mortgage eligibility as mortgage rates got to 7%. And so now that we've seen financial conditions loosen, that mortgage rate come down to 6 is the average, although a lot of people are getting them with 5 handles.
Yeah.
Uh,
FHA is 5.5. Yep.
go You got to shop around a little bit, and depending on the product, and also if you're getting a rate buy down. And so we've seen affordability come down from the highs of the mortgage rate shock. And historically, when you've kind of hit that high for a mortgage rate shock, um, you usually aren't moving back towards it. And so, the fact that inflation's come down off of its high, you would hope that mortgage rates have gone down as well. And so the premise here that I've worked with a framework from a lot of analysts for this cycle has been this order. Inflation should peak first. Mortgage rates peak second. Housing demand peaks bottoms third. Then permits and starts bottom, and then prices bottom. Now, the price one gets to be, that's where there's a lot more debate because we've had cycles like 1981 where there wasn't necessarily a bottom because prices never really fell.
Yeah,
Um,
and that's what as you know, just sorry to cut you off. That's where I anchor, right? I have this 52-year spreadsheet which I've shared with you once. My thesis has very much been we're going to repeat 1981, which meant, a 40% crash in transactions. That's why I called that 9 months ago. I am now calling, I don't know if you've heard this, tomorrow's report of existing home sales will be the one time we see below 4 million annualized transactions.
interesting. Yeah.
So again, I'm not calling for an explosion, but we won't be below 4 million the rest of 2023.
Yeah.
Um,
And so let's say demand has troughed, right?
okay,
We've bounced off the bottom for demand. It's
sure,
still possible in some of these monthly readings of things, not necessarily saying that metric, but some of them could continue to bottom, right?
sure. And
But
again, a bottom to me doesn't mean V shape or going to the moon. right? To
Yeah.
use a letter, for me, I have a big L. We're at the bottom, and it's just a long,
Yeah.
slog.
Yeah.
That's,
I
to be clear, what I'm calling. It's not a fun year, but the crash is over.
Yeah, well, what we do know 100% for certain is the free fall in demand has stopped, right? That has stopped. Now, which you could kind of classify as the trough in of itself. But yeah, we kind of need to see a little more necessarily. But there's definitely a growing chorus there that thinks that demand his trough. And for a lot of the financial type people, analysts, the reason they even have housing calls at all is because they believe it's going to be predictive for the economy and the stock market. Because
Correct.
the rate hiking cycle, usually when demand for housing is troughed and then permits trough, the stock market should already be like near at its bottom, and you kind of know if it's a soft landing or a hard landing for the economy in general. And that brings up another point. I've never been a fan of soft landing, hard landing talk for the housing market, because this early last year, the Fed decided it was going to push the housing market into a recession, into a housing transaction free fall. So soft landing, hard landing never really made a lot of sense for housing because
No, I've been very clear. I use crazy words like housing's in a depression. It may pull the economy into a recession. What's a depression? 40% crash in transactions, builders, going down 30 or 40%, cancellation rates at 60. I mean, I think housing was a target. It's the most levered business, right? It uses debt, 30-year debt.
Yeah.
So the Fed came after it, but we're here now. We're again, I'm calling. You don't make these calls, but I enjoy making them. The report we have tomorrow at I'm calling 3.987, will be the trough in transactions. We're not going up crazy high. I think the peak next year is 4.3, 4.4. So not crazy high. No V shape. But back to demand, which is the topic here. The other thing that I don't think you highlighted, which I think warrants a discussion, is consumer psychology.
Yes. Yep.
All of last year, when you were a buyer, first time or investor, you knew that interest rates were low before, right? Oh, I missed 3, I missed 4. That's why I have two top 1% agents on my channel every week. And they told me the first time rates broke 6, I think that was in August, the market stopped.
Mm.
Then the market came back and transactions kind of completed. And then we went to 7.25. It was frozen.
Yeah.
We're back to 6. So what people are now telling their agents, again, these are what people are telling me, is, wow, rates are so much better, right? Because they don't remember 4, they remember 7.5.
Yeah. Short attention spans.
Again, and then if rates don't, like to your point, if rates average 6, most people are going to get something with a 5 because they'll pay points or get a rate buy down. And some people will pay to get in the 4s. You get a 4 handle on a 30-year mortgage rate today, you're going to feel like you won the lottery because they were 7.5. It's all consumer psychology.
We had that conversation before where the best thing to get people happy about 5% mortgage rates was to get to see 7%.
Exactly.
6%.
And it's here.
Yeah. That makes sense. Yeah, there's a psychology part of it here too, which is and a part of the psychology element, which psychology element was going to kind of break first. If there was a view that home prices were falling very fast, and that was starting in some of these markets, Phoenix, Austin, etc.
Sure.
There's a psychology element there, and people can back off even more because they're like, oh, it's a falling knife.
Correct.
But if that psychology if the psychology of mortgage rates falling happened before that, that kind of changes things, because then it's like, oh, we've already gone past peak mortgage rates. Mortgage rates are going to continue to come down. And if you're a seller in some of these markets where prices have moved down, and now you're seeing that mortgage rates are moved down, you might go and say, you know what? I want to wait for a more normalized market. I see that mortgage rates are falling. I'm going to wait a little longer. Let's see where these mortgage rates go to. because in their mind, they might be thinking that this price hit is kind of a temporary thing because mortgage rates just went so high so fast.
Yeah.
So there can be that psychology effect to supply too. If mortgage
Yeah,
rates,
no question. You're right.
I'm just gonna wait. And there, you know, at the same time, there could have been that psychology, and there might be in some parts of the country where prices moving down. I'm a buyer. I'm just waiting it out. Yeah.
Yeah, and
So
so if you take this demand curve, which I think again, just looking at mortgage rates being down roughly speaking a point and a half, it's all about the marginal buyer rate. How many marginal buyers that used to get a no answer at 7.25 get a yes answer at 5.5? And the
yeah,
answer is a lot, right? It's just math. And then you could go to, hey, what is their risk aversion? That's a fair conversation. Lots of recession talk, all of that. But I think most people are like, hey, jobs are plentiful. Unemployment claims for the week got reported today, 190. Expectation was 215. Unemployment rate's 3.5, not 3.7. Right? All of these things. So if you're in tech, you're probably feeling it, right? Amazon layoff, Meta layoff, but that's not the country.
yeah.
And I think the average consumer is feeling good. I think prices are flat or boring, and I think demand's going to shock people. And I actually put this out in a tweet the other day, and I copied you on it because I wanted you to see it. That I can't wait for John Burns to change their 22% housing crash call to negative 10%, because I think that this demand's going to come back in Q1 and cause the best of the best, which I call John Burns, to revisit their analysis and say things have changed. The inputs have changed. I don't know if you saw that tweet, but I did. I did at
Yeah,
you.
and I think the thing that would be most likely to see revisions on price is mortgage rates. If it
Exactly.
becomes very clear that financial markets are going to loosen and that this isn't a plus 6 year percent for mortgage rates, that would change things. Although with Realtor.com, I don't know, because they had a 7.4% mortgage rate and then
Yeah.
prices going up almost 6%. So.
I saw that in your wonderful Fortune article. It was I was like, how could those two things work together?
Yeah, you know, sometimes I like things like that. And I liked also putting all of those together because it shows the truth, which is that no one really knows.
No.
And
We're all guessing.
you know, and so if there, you know, before I started doing all of these forecasts, there used to just be a couple that would get covered by some
Sure.
outlets. A lot of times they were like standalone. And so me doing all of them, I hope, has added some value in watering all of them down.
Oh, yeah.
I would hope. Yeah. So I think on the psychology part, there's three psychology categories in my mind. There's the price one, right? Where price is going. There's the interest rate one, and then there's the economy one. And in terms of housing activity, you've seen two of those move in a favorable place, which is recession fears maybe easing. I don't know.
They seem to be, yeah, at least at the margin.
Easing. And then the price one, I don't know. There's still some of the negativity in headlines. Obviously, on YouTube, you know, you're one of the most optimistic, but you know, you go on YouTube and see anything about housing, it's crash, crash, crash. Although,
if it bleeds, it leads. Crash, crash. You put crash in a title on YouTube, you're going to get 10x the number of views. And these people live in their mom's basement, and they live their life on YouTube revenue. So they're just going to feed the algorithm with crazy headlines. It's just how it works.
And if there is the fact that we are seeing for the first time in a decade residential real estate across the globe in some markets move down.
Oh, like Canada. I don't know if you've looked at Canada much. Man, that's a bad structure. Woo, that's not good.
And so there are things to be covered there. And in the US on the West Coast in some of these markets, San Francisco, Phoenix, and there are but there is also Louisville, and there's Miami and Philadelphia, places that are, actually, if you pull it back from when mortgage rates started to move up, they're actually seeing the prices move up, and they're still at their price. And so there's just been a lot that's gone on there. That's why I like the headline that I had a couple weeks ago, which is the home price correction or in parentheses, the lack of correction as told by two charts or something like that.
Yeah.
Because, there is some type of correction going on in residential real estate, but it's not felt in every market, and it's not felt at every price level, and
Yeah.
it's not felt at every type of home.
Yeah. The last thing I want to talk about here, we both referenced 1981. I believe you've looked at it at least in some detail. Do you want to kind of summarize what 1981 was? Because it stands out as different than maybe what people expect.
Yeah, so 1981 is later in an inflationary run that started in the 1970s. And just like today, where there's this huge debate about what actually spurred inflation, they still don't exactly know, even today. Economists still have a lot of debate, energy shocks and all of that.
Sure.
The amount of money spent at the end of the Vietnam War and all of these different theories, but inflation was running. And there were times in the 70s where the Fed went after inflation with a rate hiking cycle, and they backed off too early, and inflation came back, is the belief. And 1981 is when Paul Volcker was like, F it, I'm done messing around. And the federal funds rate went close to 20, mortgage rates 18%. And it pushed the economy into a very sharp recession. And housing really pulled the whole economy into that sharp recession. I think housing starts were down like 40%, and a lot of very bearish stuff on housing. I've shared articles. The New York Times had a piece that, the crash is here, talking about housing. The housing market is, and prices were more resilient. I'm sure if we had good regional data, or if I saw it, I'm sure there's some pockets of the country that were down, but we still kind of moved up.
Yeah. My recollection from 1981, and again, I've gone back and studied every year back to 1970, is interest rates went up about 450 basis points. So much like today, although they started at a higher point, right? So this is the second time the Fed has raised over 400 basis. However, this time is the largest percentage, right? Let's just get that out of the way. Housing starts, like you, roughly speaking, down 50%, transactions down 50%, but home prices, at least on a nominal basis, up. And that is something I've been sharing with folks for more than a year about why I think where I think all this, because housing is just more price inelastic than people expect. And you can kill the Fed can kill transactions, and they've done it again. But they really can't go after price, at least in the short term. They can if they stay long enough, but it's not a short-term V-shaped crash like everybody wants.
What I'm seeing in the data is, I think this is kind of going to fall into a little bit of its own category.
Okay.
Where I think some markets are going to be closer to that 1981, right? But I think there are other markets that won't. And I kind of look at the places already down double digits from their peak. And so already we've seen that there's some markets that have kind of deviated from that, and we've seen small national drops in the Case-Shiller. But those markets, very concentrated with iBuyers. Exactly. They got significantly overheated during the pandemic housing boom. There's not much existing inventory in those places. It got to literally the bottom of the barrel. And so there was just this really overheated markets where prices ran up really fast, and they have a higher concentration of builders in those places. And builders are very different from existing home sellers, and they're more likely to cut down, although they would prefer to do it through rate buy downs and not actual prices, but they are doing in prices, and we'll probably see more of that in the next 6 months. According to the places like Zonda that work with the builders. And so I think there's a different story. And I think the reason this kind of falls into its own category, obviously this isn't the 05, 06, 07, 08 through 12 type story, but I think it's its own unique story. And if I had to summarize it in one line, it's you know, the pandemic housing boom and then a historic mortgage rate shock. And
Yeah,
so
I agree with
just
that.
vulnerable in different ways and in different markets. But at the end of the day, it's, what is the data showing us? And what the data is showing us is that it looks like mortgage rates have peaked, supply is still very tight, and a lot of markets east of the Mississippi haven't come off their peaks.
Yeah. Well, Lance, you are all things housing for Fortune, and you have a wonderful Twitter handle. Where can people follow you and say thank you for coming on One Rental at a Time?
Yeah, they can find me at News Lambert. And right back at you. I think you do a great job on this podcast. I think you have really good guests on and good content. And also, if anybody wants to read my work, they can find me at Lance Lambert Fortune in Google, and I'll be the first thing that pops up.
There you go. Folks, do me a favor. Go on Twitter, send him a quick tweet thanking him for coming on weekly with One Rental at a Time, because he does not have to do this, but he gives us about an hour each week. So, Lance, we all appreciate you. Thanks, buddy.